welcome to the next edition or the latest edition of TCA Crossroads. Where entrepreneurs and investors connect, I'm David Friedman with my co-host Dave Berkus, and hope everyone is having a great towards the end of the year and planning for the holiday season. Hi, Dave. How are you today?
I'm fine. Exactly. And David, the background never seems to change. The time is always the same, and there's never a cloud. And I don't quite get it, but you must be living in some kind of heaven.
It's really funny because it's been raining, and the green is because it has been raining. So,
Okay.
it's kind of funny. Every time we seem to do the forecast, these presentations, the sun always comes out with radiance to, soak us in beautiful sun and gives us a very good perspective and, sets the tone correctly in my mind.
So I'm a musical fan. From Annie, the sun will come out tomorrow.
Don't start singing. I think that will be we'll lose more viewers like that. Reminds me of my days of doing doo-wop on the streets of New York, but my voice has died since those days early on in my life.
All right.
Yeah, today I'm really excited because as we move towards the end of the year, we can take a look back on what has been transpiring in the angel and the VC world, both, and we'll talk about that. And then I'm going to let you do most of the talking, but I'd like to chime in on things that I believe I'm hearing from entrepreneurs that seem to run counter to some of the data that I'm also seeing in the market. But you're going to present stuff from the NVCA as well as Carta, and I think this is going to be very exciting and interesting for the viewers, and hope they enjoy it.
So this is the third quarter highlights that I've compiled from PitchBook and the National Venture Capital Association and from Carta. So this is something you can't get from other places, because we've taken this and put it into what I think to be the right way in which to look at it, from early stage valuation to exits. And so let's just jump in here and see what we can do in the period of time that we have, far less than a minute per slide. So as an overview, the high-valued companies are remaining private. And we knew that there was this backup of the train behind the engine that couldn't. You remember during 2023 and 4, nobody could get an IPO out. In fact, in 2023, there were only 5 of them. And then, as you know, many of those kind of crashed. Their valuation went down. So the VCs and the late-stage PE investors just kept these companies private. And now if you look at the overview, that's exactly what you see. In 2025 so far, 69 companies that would have gone public have stayed private. And the trend is up again, which means it looks like that there is no IPO in sight for many of these companies. And that's because people want to maintain the high valuations. And I guess I can't blame them. So first-time fundraising capital, which is where we play, improves over 2024 as the fund count falls short. So what that means is more money is being put into the market and there are less companies receiving it. We can understand that because you and I have talked in the past about how this has been a stalled marketplace and we haven't been able to get enough companies through. But there's a lot of money going to the companies that do get it, especially in the subsequent rounds. So we're looking now at a graph that is showing 2025 looking a little worse than 2024, but I always have you come back and look at 2021. Look at that number and look at the number of companies that continued to go through the first-time fundings in 2021 and 2022. So we are way down in number of fundings. The amount per fund is up. So here from Carta are 2 graphs. David supplied them to me just yesterday, and they were interesting enough to put into the presentation. This is total cash raised and the count of the number of instruments, meaning documentations by quarter, is pre-seed rounds on safes and convertible notes. So the first graph is the total number on cash received. And if you'll look at 2025's by quarter, this is the third quarter down from the second equal to the first, but you'll look at the third quarter down from every quarter except 2023's fourth quarter. What it means is the amount of money raised is not raising, it's actually less. And in the pre-seed arena, if we look now at the count of number of companies that at least Carta has counted, remember Carta doesn't get everything, it's less again than the previous quarters. And in fact, at 5,660, you have to go all the way back to a little bit above Q1 2023 to see the smaller number of companies getting funded. Not necessarily the best news. David, I'm going to stop there and see if you have any comments, and then we'll go on.
It's interesting to see Carta's numbers because the numbers are very large. Now, TCA will look at a few thousand a year collectively across our network and our strategic affiliates.
Right.
And we invest in a small number of those. It's funny because we're seeing an influx in certain market spaces, certain market segments. So we're seeing more in the biopharma area, health tech, wellness, AI. So
AI.
that you may find later on in your statistics showing something that correlates, but we're seeing a heavy thrust forward in velocity of those companies in those areas. We're seeing pull back in some of the others. We're not seeing very much in the consumer packaged goods or consumer products area. We don't see a lot in real property tech. Even in finance, it has pulled back a little. We're seeing some more in blockchain and financing using tokenization. But
Okay,
from an angel point of view, I don't see the problem. We're seeing deal flow that is significant.
I'm going to show you how the opposite is true in the seed and A, B, and C rounds, and we'll get to that in just a few minutes. So as of the end of the third quarter, 2025 had fewer large pre-seed rounds than in 2024. I think we showed that from Carta, and this is just now a way of looking at it in a little different light. Numbers of, but you'll see all of the bottoms of each of these sets of graphs down from the previous quarters. And that's not necessarily good, but we know there's a lot of cash out there, and we just wonder why it isn't being deployed. So PitchBook says the step-ups are modest due to the high valuations that we gave pre-pandemic. And so here, if we look again at Series A, unfortunately, it doesn't give us pre-seed. So we have to start at Series A for this. That'll be the dark blue. It's starting to turn up, and you'll see that that is a fairly good sign. However, pre-seed, you'll see, is a little bit different in a few moments. So how about the valuations for sustained investor interest in AI? This is where David just a moment ago made his comments. So if we look at quarterly deal count in AI, look how the 2025 deal count suddenly popped up in quarters 1 and 2, and we don't have quarters 3 yet, so that's not going to help in this particular slide. But it does show that there's been a whole lot of an increase in deal flow and in dollars in the AI sector. Nothing new. We expected that. I have a further slide, I think, that will show the healthcare as a general slide as well. So tech IPOs are hot, biotechs are not. And that's the slide I was looking for. Surprise. Not that the tech IPOs are up, that we expected. But the fact that the biotech IPOs are not, that's something. Now we're talking about IPOs, not about initial fundings. And so the exit value are the green bars, and the exit count is the line item. So the values are going way up. The count is going slightly up. So there is some movement of the engine of the train, at least for IPOs for tech, but not necessarily for bio.
Yeah. Can I make a quick comment on that?
Of course.
Okay. So, it's very interesting data, and I think part of the reason why we're not seeing the exits on the IPOs for the biotechs is it's taking a lot longer for some of the companies in which we've invested in the seed round or second seed or even bridge to A to get through the FDA process. They're doing more clinical trials, more skepticism perhaps. So we won't see those IPOs because it's taking a lot longer to get the products and the companies developed to the extent where the next round makes sense.
Okay, I'll take that. So here we're looking at a graph that I don't think we've seen before. It is whether or not deals are investor friendly or company friendly. And so if you look at early stage index, which is us, that's the blue at the bottom, at this point, it is turning toward, if you try and figure this one out, investor friendly. If it were way up to the 90 and the above area, it would be companies are demanding and getting valuations and terms that they wish. And now it's turning down. The investors are more in control. And there's no reason to suspect that there's a change here. The investors are the ones that have been miserly with their money and not quick to invest. And this is what the graph shows. 2025 deal count through Q3 at least has already surpassed 2022 through 2024, which is not too bad an idea. But remember 2021, we have to always kind of tip our hat to that, a number very much higher than everywhere else. But then look at 2023 and 24, and then on the far right, 2025. So good. Deal count for VC activity, at least, is way up. And that kind of helps and gives us a chance to think that we'll be pulled forward by some of these deals as well. The investor conviction for AI, this is what you said, David, but look at this. 50% of the deals that are done today are being done in AI. 50%. So you have to take all those other things that you heard David talk about a few moments ago and add them all up, and they don't equal 50%. Ouch. So it turns out that the deal count is up 39%. The dollar volume is up 50%. The prediction is that the end of 2025, that number is even going to increase further, and AI will be 64% of all deal value. Let that one sink in. Ooh. So I did this from something that came to me from another source. And this is the attempt to show the AI agent market markup. How many maps, how many companies in each one of the different kinds of tech. And there are so many. I've seen this graph before and it's growing. The number that I last heard was 3,000 companies. Of course, there aren't going to be 3,000 in this graph, but it gives you an idea now that there is the beginning of a winnowing out of the number of companies. We predicted this will get even more intense over time. But more important, we can now see them by sector. I know you can't read this as easily as you might, but you can read the very first one, which is enterprise tech, and just get an idea for some of the bigger companies that are dealing in enterprise tech, which, by the way, is where I play. The sub $5 million deals where we play have declined. So the share of VC deal count by the size bucket says that deals by VCs, so be careful, this isn't just angels, of less than $1 million, that's the dark green of the bottom, have declined kind of steadily. If we see 2015 on the right-hand bar, or left-hand bar, it is almost double, my guess, of where it is in 2025. So sub $5 million deals, down. Why? Because our valuations have been pushed and our amounts of investments have been pushed by syndication. We know from the ACA, the ACA report that John Harbison and others put together, that the amount being supplied by each individual angel group seems to have declined over this last year or two. I know it has been true for the TCA fund, but it is now a question of syndication to get this number up to a point where the companies that need it are getting the cash that they need. Here's a graph that says the median pre-money valuations have climbed across the board. But if we look now at where we were for, or where we are for pre-seed, it is that tiny number at the very bottom. Our valuations, it says, are below 7 million. And yet the ACA is telling us the valuation averages is 12 or 10 million. So there's
Yeah.
something wrong with the way these two graphs are lining up.
We hear, and I'm sure you have too, that the entrepreneurs say, look at this data. We see these pre-seed companies at $7 million average valuation. Therefore, we'll come into you all for $7 million. Or the next one is going to be $15 million for, a seed or a bridge to A. And we're trying to say that the numbers, the way they count the numbers or the way they portray the numbers doesn't seem to make sense relative to what we see as the risk reward. So notwithstanding these numbers and these valuations being high, the entrepreneur really needs to understand that in the angel world where they're going to play in the pre-seed and the seed and the second seed bridge to A, the valuation has to be such that it makes sense for the angel to have a good investment return, what they call multiple on invested capital, or MOIC, right?
Mike.
So I don't know, do you see the same thing that I'm seeing?
I do. And I want you to look at the right-hand graph that says the median deal size increased on all series, but then look at the pre-seed valuation, the deal size, I'm sorry, $500,000, $500,000 is the average pre-seed deal size. And that's one of the problems because, these companies are coming to us in the main looking for more than $500,000. How about the investor trends? Corporate venture capital, CVC, activity pacing is roughly flat for 2024 and 5. And that's where a lot of the money that we like to see coming into our companies after our first pre-seed rounds. So it's telling us the deal value is going up, the number of deals is going down, and corporate venture capital is roughly flat when you look at the long run. And again, they were active, corporate venture capital, in 2021, but I'm getting a little redundant in saying that, huh, David? Because 2021 was an outlier year.
Yeah.
Venture debt. We ought to talk about that sometime. In fact, we have, with one of our sponsors, talked about that. Venture debt is becoming much more of a factor. So the high loan value has outpaced the loan count. If you look at the loan value, deal value, that is the red, and the deal count is the blue. We don't have it in 2025 to end, but look at the little dot in the middle in 2025. That means the count's going to be way down, but the dollar value will stay way high. So venture debt is filling the gap for later stage, but not at all for the pre-money stage that we are. How about the fundraising? The deal value is on track to land near a decade low. This is VC again, and so you have to take this with a grain of salt. You can't call this what we see in TCA Ventures because we're dealing with pre-money or pre-revenue companies in the main, or very early stage otherwise. But look at the slide in that graph. The capital raised for fundraising, in this case, is the amount raised by the companies that are deploying their money. Typically, these are small VC funds all the way through the very large funds. They aren't raising as much capital. I'd like to think that it's because they have so much sitting on the side waiting to deploy. Now we'll go to exits. And in the exit world, 2025's value, through Q3 at least, has already surpassed 2022 through 2024. Hooray! And I can kind of validate that. I've had a couple of exits in 2025. They were big, and they were bigger than before. And that's a good sign. But the big exits that I had were in 2021, and I'm just like the rest of them if you look at the graph for 2021. The VC-backed companies are becoming the prominent acquirers. Think about that one. So if a VC finances a company with, pick a number, $20 million, those companies are growing more than organically by acquisition of smaller companies. And that's what this graph is trying to show you. The dark is the share of exits by the smaller companies being absorbed. And the light one is the share of the value of those companies. Now, we don't have much for 2025 to show. It looks like it's going up a little bit as far as value and a little bit down for the deal count. But companies are being acquired, and that's where we want to play. As you probably know, David, the average acquisition value for companies that we finance is between $30 and $40 million at exit. It's not the $1 billion exits, but we're coming in at 5 million to 10 million. And so we're getting 5x. If we come in at 5 and exit at 35 and there is no action in between, that's a 7x. So there are things that we look for in that range of 35 to $40 million. Acquisitions are increasingly concentrated among early stage companies. And that's just what we showed with the graph before, right? So pre-seed acquisitions don't happen very often. I mean, they're picking them up before they have any revenue. So that's the very light, kind of an orange yellow at the very bottom, being crushed by the seed. So seed means we've made an investment at pre-seed and another investment came at seed, and then those companies are acquired. That's what this graph is trying to tell you. And that number is increasing, and it's happy to see, because if you look at valuations at the seed, those are in the $30 to $40 million number. You know, I just had one that was just a couple of weeks ago that we just got our wire transfers. And I have been chairman of that company for 19 years. Now, it's still, we made enough money to make it a high IRR, but that's something that makes you wonder when the early stage investor has to wait 19 years sometimes to see the money. Now, the average, we have to argue because the Angel Capital Association thinks it's now 7 years. At one time, they thought it was 5 years to liquidity. Mine, I've told you several times, was 11 years on my average to liquidity over 212, I guess 38 exits, but 212 investments. So it's turning out that pre-seed is increasing slightly, and that's a good sign for us, but not enough to make a celebration. David, have you seen the same thing as far as the exits for the companies that we financed?
Yeah, I'm seeing a delay in the exits. Last year, everyone was bemoaning the fact that exits didn't occur very frequently. 2021 was great. I remember having a few quick exits, you know, within 2 years, 3 years, or quick failures within 2 to 3 years. So it was great. Last year, I may have had one exit. This year, nothing really, which is interesting. But a lot of the ones that I'm investing in are in the biomedical pharma space. So I expect, you know, like I mentioned before, it's taking a lot longer for them to get through the FDA to finish their trials. So about 90% of my own personal, you know, sidecar investments are in the biomed pharma health tech space. Most of my other ones are through like 9 funds, the ACE funds, the TCA funds, and that's like drips and drabs. But I am seeing clearly a longer time for exit, which of course is a problem because when new angels come in, they want to have something a lot faster. And because the markets have been really good with liquidity, and they're saying, well, why am I investing in angel rounds in the pre-seed and seed with a lower return, just as you pointed out, when I have the liquidity, less risk, and I can get these good returns, especially on crypto, blockchain, AI, and other high potential markets. So there's an interesting dynamic at play for both, and a learning for both the investors as well as for the entrepreneurs. Now,
That's good, but I have heard the same. I've seen the same in conversations with angels in our group.
okay.
And so it is a challenge for all of us. When I first joined, it was like picking cherries. It was like picking apples off the tree. There were so few deals that we could find. Well, we could find the good ones very easily. And those deals matured very much sooner than the deals today because there are so many more.
Yeah.
All right.
Well, we know, for example, that based upon some information from Peach Score, for example, that there's a lot more interest in becoming an entrepreneur, a lot more courses in schools, a lot more accelerators. Peach Score, of course, is an online, accelerator plus other things as well. And we're seeing many more people getting into the market, but it's getting tougher and tougher to fund them and to get the return in a reasonable time. That's what I'm seeing.
Good. I mean, yes.
Yeah, they're not good.
They're not
I get
good.
it.
So here are the VC-backed M&A activity deals of 500 million or more, and they're going up, and that's a very good thing. Now, we've had 3 of them in the last several years. We had DTX at $1 billion, but half of that was held back waiting for FDA second stage approvals. We had a $500 million from Influential, which I was there at the founding table, as I've said before. And we had another one whose name I've forgotten, David. Maybe you can help me. That was a fairly big one. I don't know if it got to $1 billion. That
Yeah,
was
I know which one you're talking about. That was the 44X that Pasadena had, I think.
right.
Right? Yeah, I forgot the name.
Now that's 2 of us. Uh-oh. Either we're getting old or we weren't in it. And I think we weren't in it.
I wasn't
So,
in it. No. Yeah.
well, okay. The average months to close on an M&A deal, if you start the transaction from the point when you hire the investment banker to the time when the money is in the bank, the time is increasing every year. Now, this only goes up to 2023, but look at that. It's taking 10 months from the time that you begin to try and find your acquirer to the time that you finally get the wire transfer. That's up from 7 months in the year 2000. 7 months. I have been telling people it takes about 5 to 7 months, but I'm experiencing it's taking longer. It's because the buyers are doing more due diligence and they are being a little bit more conservative. And you're seeing that now in this graph. So thank you. That's our presentation for today, folks.
Well, let me ask you a couple of quick questions, and just to wrap it up,
Sure.
what would you, given the data that we just saw, what are the implications and the prescriptions for angels, and what are the implications and prescriptions for entrepreneurs? So let's put this in context as a summary.
That's a good one. Take all these graphs together, eliminate the very late things like PE and large scale, uh, Sequoia size venture capital. And I think I come up with 3 conclusions. Number one, it's taking longer to make a deal. And we have to be careful about that because we know the companies don't like this long phase in raising money. Number 2, the valuations are coming down a bit from the intensely high valuations of 2021 leading to 2022. And number 3, the amounts that we are putting into those companies is decreasing. And that hurts. The only way that it increases is by, as you saw from one slide into my comment, syndication. Those 3 things. So patience for the investor, patience for the company, but patience for the investor especially. And watch out for the valuations. They're coming down. That's a good thing. But don't expect to raise too much money in the very first rounds. Be a little bit more frugal in the way you're planning to spend your money and the amount of money you're asking for.
Yeah, I just want to add one other thing to the entrepreneurs, because I really have a big empathy for the ones that struggle. They have to have a significant amount of emotional intelligence to bear with, the environment that they're operating in or trying to get funding in. There are 2 things that I think the entrepreneur needs to do, and I think this will help them. Number one, tell a really good story about how the business will grow, how it's scalable, how they're going to use their team to build a good product roadmap or growth story. But the other side that they have to understand, it's not only the business that has to be really good, it has to reflect the investability from an angel perspective. Will the angel be able to get a reasonable return on their capital over a period of time that befits the risk they're going to take with some of these early stage companies? So you have to really do both to really do a good job. And for the investor, one of the things that we're trying to do at TCA is to expand the opportunity, not only to look at the seed, pre-seed and seed round, but also to look at maybe private debt, look at other investment opportunities that return capital and give you a decent return earlier. Those are all, and it's not only TCA, it's when I'm on the board of the ACA, and we're doing the same thing, looking at other options. But with that in mind, I think the data is really relevant. I think it should be thought-provoking. And I'll leave it for you for any final words that you have, since you did such a great job in presenting it. Anything that you want to leave anyone with, some words of wisdom?
Only to say that patience is a virtue. And that's true for everybody. And it's unfortunate, but it is the truth. David, back to you to conclude us all.
And with that in mind, wishing everyone a happy holiday season. We're going into that time. We hope you enjoyed today's session of the podcast. We hope you got something out of it. Let us know what you like. If you do like it, click on like, share the link with other people. We're on Spotify, we're on Apple, we're on YouTube, and we hope to see you next time. With that, I bid you farewell.